We begin today on the busy week ahead for markets. And investors are shifting focus this week from rate hikes to corporate earnings as the reporting season officially kicks off. Wall Street analysts have reduced their S&P 500 earnings expectations for the third quarter by 6.6%, the biggest downward revision since mid-2020. Let's set the stage here. Of course, we have a lot of big earnings out this week by the banks later in the week, but this is where we are with earnings. And I'm going to bring this to light from the Goldman Sachs note out over the weekend. At the start of July, consensus expected earnings growth for the S&P 500 companies at 10%. That has now been lowered to 3%. And of course, you have inflation problems in there, but you have the impact of the strong dollar that I think is still being just misunderstood on how much that could hurt sales and profits by S&P 500 companies. We got a taste of it, Nike. You're going to get a lot more taste of it soon.
Yeah, and I was actually taking a look at some of the FactSet data, which actually is mirrored with what you were just mentioning and citing there a moment ago, and really looking at this growth rate perhaps in earnings. If 2.4%, based on some of the FactSet data, if it's actually 2.4% earnings growth for the quarter, it would mark the lowest earnings growth rate reported by the index since Q3 of 2020. We all remember what was taking place back then, and where even with some of the movements either on some of the therapeutics, the precautionary measures as well that were still in place, given where we were within the COVID-19 pandemic and the earlier phases of that pandemic relative to now, given that we've already seen so much of the companies try to really build off of the momentum that they had seen in 2021, 2022 has really been kind of that punch bowl being taken away from the party. And now it's, as some banks out there or some analysts are describing it, as the hangover after the party here, too.
I mean, to be clear, and just a little caveat here, that 2.4% that FactSet is modeling, it's never as low as they're modeling,
Sure.
right? Companies always, on average, come out and beat estimates, right? It's something like 3/4 of companies typically beat estimates when it comes to the bottom line, although that number varies a little bit. So that's sort of the caveat. That said, the vibe is bad. There's no way of getting around that, right? One of the ways that that's being evidenced is Bloomberg does what they call their MLive Pulse survey, and they surveyed 724 respondents, folks who are money managers, et cetera. More than 60% of them say this earnings season is going to push the S&P 500 lower, and the valuations are going to come down. So we see, obviously, that there's a lot of pessimism here. Is it enough for so-called capitulation, where everybody throws in the towel, then paving the way for things to go higher? That's a question we've been asking over the past couple of weeks as we've seen selling continue. Doesn't seem like that we have necessarily gotten there yet, especially not necessarily before that earnings season happens.
Looking for some earnings beats here, Julie.
Well,
okay.
I mean, there's always earnings. There's going to be some earnings beats, obviously.
Fair point. Brad, you mentioned facts. Let me just one more point here. From the straggler companies that reported over the past few weeks, 50%, according to FactSet, 50% of the companies have called out the unfavorable impact from foreign exchange. So you have to be watching this moving forward, especially for multinationals.
And it is the question of, to your point, Julie, throwing in the towel. What does that actually look like? Right. Is it outright pulling earnings or just kind of pushing down some of your expectations going forward, not just for the rest of this year, but going into early 2023 as well?